Okay, welcome everyone. Hi traders. Welcome everyone to our third webinar of the series of webinars about volume, footprint charts and cluster analysis. Great to see everyone here, and both those who are new here and for the first time joining our webinar, as well as those who are here already for the third time in a row. Let's do a quick sound check. If you can see and hear me clearly, can you please put a plus in the chat? Just so I know that everything is working fine and we can move on to our today's topic. Just put a small plus in the chat before we continue. Okay, awesome. Thank you so much. I can see pluses in the chat, then everything is working. So let's get started. Fantastic. Today we are continuing our deep dive into cluster analysis, and to quickly recap it, so far in the first webinar we talked about the mechanics of price movement in the market auction and how the price is formed through the interaction of limit orders and market orders. Now then, in the second webinar, we took things a little bit further. So we broke down bid and ask distribution. We talked about how their behavior can help reveal the activity of large players in the market. And we even looked at a couple of practical trading strategies. So if you watched the previous two webinars, can you please drop 111 in the chat? So if you can please drop 111 in the chat if any of you have already attended the previous two webinars, so we can see how many more participants, new ones, and also the previous, those of you who already joined before, we can see. Fantastic. Thank you so much. Swirls, Paul, Tomek, I can see your comments in the chat. Fantastic. Amazing. So welcome back. Welcome back, Joy. And if you are brand new here, absolutely no worries. I'll quickly recap the key points from the earlier sessions so you can follow alongside with ease. Okay, so you will be caught up in absolutely no time. Now, let me switch our chart, our screen just like this. So first things first, what we are going to be covering today, one moment, there we go. We are going to be covering today is what most traders have seen already, but usually they don't know precisely how to use it. It's a vertical volume bars in the combination with a footprint for your best possible entries. Now, most traders already had some experience with vertical volume. It's usually the first thing that appears when you open any new charting platform. But not everybody really understands how powerful the potential is in the vertical volume. So today we are going to change that. We'll explore how those simple volume bars on your chart can reveal the interest of large participants, help identify the key support and resistance zones, and show us when buyers or sellers are taking control of the market. And then we are going to take it a step further by combining volume and footprint signals to increase clarity and accuracy. So in this practical section today, I'll walk you through true trading setups. But first of all, again, if you have seen this indicator ever on your chart, or perhaps you have even used it before, can you please drop plus in the chat? This is a vertical volume indicator. Just want to see how many of you already have had some kind of experience with this kind of indicator before. So once again, if you have used it before, plus in the chat. I see Paul, Tomek, amazing. Thank you so much for your interaction. So what we are going to be covering today is two trading setups. One is going to be a reversal setup where we use volume plus footprint to spot where a trend may be losing strength, and you can quote some beautiful reversal entries. The second setup that we are going to be covering today is a trend continuation setup using volume, delta, and cluster analysis to jump into strong momentum moves. And of course, I'm going to walk you through the live chart examples inside ATAS so you can see how it all works in real market conditions. And all the way at the end, I will open the Q&A session where I'll answer your questions from the chat. So please feel free to type them as we go, but just know that for majority of questions, I'm going to be getting back into all the way in the end of the webinar to keep things structured. Okay, so sounds good? All right, I see your pluses in the chat. Thank you so much. I love this interaction going on, so let's get started. Get comfortable, I would say, close your distraction, and imagine that you are sitting in the very trading classroom, which more or less is exactly this. So let's level up your understanding of volume together today. Let's slide into a little bit of theory. So volume, vertical volume, also is simply known as the volume indicator. And it is a familiar histogram of bars located under your price chart on any charting platform. And as you may see, majority of you already had experience with it, as we can see in their interaction in the chat. So you've probably seen it already, and each vertical bar shows how many contracts or shares, or for instance, lot sizes, depending on the instrument that you trade, were traded during a specific times. In simple terms, it reflects the total traded volume for each and every single candlestick, regardless of whether they are trades of buyers or sellers. It captures altogether whole activity as a total, okay? So how is that volume calculated? So the volume formula itself, the volume which is you can see right now in front of you, right, under your chart, is very simple. The formula is ask plus bids, and every time a trade is executed, whether it's a market buy or a market sell, it gets added to the total volume count. So for example, if 5 contracts are bought and 5 contracts are sold, which always happens together, right? Because every trade needs both buyers and sellers, the total volume increases by 10. Okay, so all together. So throughout the candle's time frame, let's say 1 minute or 5 minutes or 30-minute time frame or 1 hour, it doesn't really matter, all trades get added up. So at the end in the interval of the period that you choose, we get the total number of contracts traded, and this is displayed as a volume bar under the candle. And essentially, the higher the bar, the more trades took place during this candle, meaning there was more market activity. And it's also important to know that closing a position, which I mentioned before, but I want to repeat it to make sure that you all understand it really clearly, closing a position is still a simple separate order. And therefore, it counts towards the total volume. So both opening the positions and closing them count as a separate type of order in the volume. So what does the vertical volume tell us? Well, first of all, it shows the level of market interest at a given price movement or a given price area. High volume means money is involved. It's actively entering the market. A lot of participants are actively traded, potentially even those maybe institutional players. Low volume, on the other hand, means there is a little activity, lack of interest, very few market participants at this very moment, and essentially it's a quiet market. So by analyzing how volume behaves from candle to candle, we can start to interpret the strengths or weakness of a trend and the interest of market participants in this specific asset at this very moment. So if the price is rising, for example, alongside with increase in volume, the trend is healthy, strong, and it's been supported. On the other hand, if price, for example, rises, but volume drops, it can be a red flag because it may be a sign that the move is losing momentum. People are exiting the market, okay, and there are few participants left. But we'll come to those rules in a little bit. Now, what is important to understand is the difference between vertical volume and the cluster view or the footprint chart. We covered the basis of the footprint chart in the previous 2 webinars. So for those of you who perhaps missed it, you can find the link in your email and go rewatch the previous webinars for in-depth understanding on footprint charts. Clusters, right, footprint charts, let us look inside each and every single candle. So if vertical volume, for example, gives us just one number for the whole total candle, for example, 1,000 or 10,000 contracts traded in 5 minutes, depending on the instrument, the footprint breaks it down. So it shows us that like 1,000 contracts across each price level within the candle were distributed in a certain way. So in the footprint, we can see how much of the volume was aggressive buyer, for example, executed on ask, how much was aggressive selling executed on bid, and for each price level separately. So you can think of the vertical volume as a summary or a total, and the footprint as a breakdown, showing who was trading specifically and where. Okay? So you can see on the chart in front of you both the representation of footprint for the same period of time and how the volume was distributed in each and every single candle. Now, the question is, how are these tools different in practice? Okay, so vertical volume, it shows those volume bars under your chart, answer us the one main question. Was there a lot or a little trading volume during this specific candle or this specific period of time, essentially because every single Japanese candlestick is adjusted to the certain period of time. So it helps us quickly spot unusual or low or high activity also, right? Because unusual can also be unusually low or unusually high activity in the market. And it also gives us a feel for an overall activity level. For example, if you are trading futures, you may feel it less. But if you are trading a stock market or some cryptocurrencies, which are not the mining cryptocurrencies, but miners, right, not majors, it's actually going to be really important to trade the higher volume assets. Because if you're opening the stock price chart and you see that there is absolutely nothing going on, the volume is very low or barely any volume there is in the market right now, and the price is barely moving, it means that there is no interest to this specific share, to this specific stock at this very moment. And if you enter this type of market, if you enter this position, you may be stuck inside of consolidation. So you are not really interested as a trader in stocks or cryptocurrencies, which have very low volume and barely any movement, because it means simply there is no money in the market. And if there is no money, the price is very unlikely to move anywhere, and you are very unlikely to get any profit from it. So you're going to end up paying commissions, but not able to make any money, which defeats the whole purpose. So that's volume. Now, footprint charts or clusters go a step deeper. So they answer a much more specific question. How exactly did the trading unfold inside this very candle? Where were the buyer biggest trades? And who was in controls, buyers or sellers? You can think of footprint chart like an X-ray vision for your candle, essentially. They show you how volume was distributed across every single price level. So for example, you might see that out of 1,000 contracts traded on 5-minute candle, which volume shows you, most of them were, let's say, aggressive sells. And they were all clustered around a very narrow price zone. The vertical volume wouldn't show you this detail. It would simply say 1,000 contracts were traded in this candle, period. That's it. And that's why both of them, volume and footprint, are extremely valuable. Volume bars are simple and visual. One quick glance at the histogram below the chart and you can spot spikes or drops in the activity. Footprint, on the other hand, is more complex, but it offers you much more precision. So now you can see who is applying the pressure, bulls or bears, and where large limit orders are sitting, and how the action is playing out on every single price level. So for decades, right, for many decades in the market exists, traders relied mainly on just price candles and volume. So open, high, low, and close, plus that very volume histogram. But now, as we have footprint charts and we can combine both those tools for the deeper insights, it gives us a very big privilege as traders. So today, our goal is to learn how to read vertical volume consciously and to understand what is really happening inside clusters where volume starts to shift. Now, quick question for every single one of you. Who has already tried using footprint charts after our previous webinars? Because the previous two webinars were dedicated specifically for asks and bid distribution, market auction, and we also talked about footprint. And in the previous second webinar, we even covered several strategies on using footprint for both reversals and trend continuations. So can you please drop a 1 in the chat if you've already used footprint or tried applying it in the chart in your trading, and can you drop 0 if this is the first time you hear about it, or perhaps you just didn't try testing it before. So 1 if you have had some kind of experience, a lot or a little, and 0 if footprint is completely new concept to you. Okay, I see quite a few ones and a couple of zeros. Okay, that's awesome. Now, if this is the first time, I will briefly explain so you will get what footprint is for, but just make sure to go and rewatch the previous two webinars as well so you get in-depth information on footprint charts. Syed is saying, I don't like footprint. Well, I hope that today's webinar is going to shift your opinion or perhaps give you a strategy on the combination of volume and footprint and give you a different perspective on the topic. Okay, so I'll break everything down in a clear and simple way, and I'm pretty sure that by the end of this webinar, you will want to give it a try, both Syed and everyone else. Okay, so how does volume help us to detect interest from large market participants? Let's have a look at the chart in front of us. The idea behind it is very, very simple. When big money enters the market, it leaves a visible footprint. That's where the name footprint comes on in the previous, in the very first place. Okay, so footprint is volume just distributed by asks and bids, aggressive buyers, aggressive sellers, and passive buyers. When you suddenly see a candle with volume that is 2 or 3 times higher than normal, chances are that it's not retail traders entering the market. It's large players stepping in with a very significant order. As Alexander Elder once said, all trades leave footprints on price and volume charts. And the bigger the trade, the deeper will be the footprint. So let's say that on average, the chart in front of you is a mini S&P 500 on 5 minutes. So a candle on a mini S&P 500 during the period represented on the chart, and suddenly, out of nowhere, you see an 85,000 contract spike. On the left side, an average volume is approximately 20,000 contracts per each candle. We see it steady and stable. And suddenly an 85,000 contract spike. This is more than 4 times bigger than the average volume traded during this period of time. And as we can see, this is not because the market was opened. That was already past the point. So this spike immediately gets your attention. It's a signal. Something out of ordinary has just happened. Okay? So maybe a market maker unloaded a very large position. Or maybe, for example, a major buyer absorbed a wave of aggressive selling. Okay, either way, whatever happened, a big spike in volume is like a radar pin for traders. Something significant just took place, and you perhaps can make money on this very situation. And it's not just about the absolute size of the bar. It's also about the change. So if the market was calm and trading low volume before, and suddenly you can see that the volume rising after candle, that's a clue. It might mean for you that the smart money is starting to position itself in the market. And before a strong move, we also always, often see volume to build up gradually. Okay, large positions quietly entering the market. Other times, like in front of you, right after, for example, a key news at the session open or like sudden release from Trump, like in the past couple of months, volume jumps as large order hit the market really fast. In any of these cases, a sudden abnormal spike in volume often equals the presence of big players. Now, let's make this very clear. A large volume bar itself, present on the chart, does not tell us whether the big player was buying or selling. To figure this out, we need footprint charts and some market context. And also keep it in mind that each instrument that you trade has its own typical volume rhythm, okay, volume pattern, as I love calling it, tied to session times and liquidity patterns. So as you can see, every instrument that you trade will be increasing in volume and decreasing during the certain periods of time, and it depends on the trading sessions. In front of you is a chart of mini S&P 500, and it will have two spikes of volume repeating itself every single day, at the moment of market opening and before the market closure, when traders have to close their positions before the overnight clearing. So those types of volume spikes don't necessarily signal something unusual. We can take them into account, but the most important are the volume spikes that come out of nowhere or as a result of the news event. Okay? So when volume stands out from the usual flow, we always take notice. But we need to know if this is because the market is opening, the market is winding down, or because something unusual has just happened. And that's our first key takeaway that I want you to make a note on. When volume spikes far above the norm, it means something big is showing the interest in the market. Something or someone. It can be the hedge fund, it can be a private big trader. And that gives us a reason to zoom in. And this is a pattern that we will be using today in the later examples and as setups. Volume tells us where to look, and footprint tells us what is happening there at which exact price level. That's where we will often find the beginning or the end of major market moves. Okay? So next up, let's talk about how vertical volume helps us identify key support and resistance zones. So how does this work? It's actually pretty straightforward, as you can see in front of you on the example on the chart. So where large buyers or sellers step into the market, we see a surge in volume, and that area becomes significant on the chart. For example, imagine and see an example that market was surging and reached 5300 level. And suddenly you notice a massive volume spike on your volume bars below your chart. That means that there was intense trading at this very price. Someone was trading quite aggressively. If the price then closes upward from this area, it suggests that the strong buyers stepped in near 5300, 5305, absorbed the selling pressure potentially, and pushed the move further up. As a result, the price zone becomes a potential support level because now we know there is a demand sitting there. And we can see how the price held the zone and continued the upwards trend afterwards. So you see again the steady, calm volume. The price has been dropping, then reversing. And then after the reversal, the huge spike of volume appeared, which is more than 2 or 3 times higher than the average volume traded at this very moment on this very instrument. Now, I want you to make a note on this. I always wait until the next candle closes. The volume bar itself doesn't tell you everything. What matters is where the next candle goes. In this example, we wait for the next candle and we see the next candle is heavily bullish. So the market actually went up after this huge volume entered the market. After this happened, we can assume that those were big buyers entering the market. And when the price returns there, the big buyers will be likely holding the price because they won't be willing to let the price go below and take them into the drawdown. So I always wait for the next candle. And this is one of the most important key takeaways. Wait and do not rush into the market. Don't chase the trade. Don't jump immediately when you see something is happening. Wait until the next candle. Now, in this example, it's a 5-minute time frame. Okay. So the question in the chat, I see this is a 5-minute time frame, but you can use the same exact idea on different time frames. I usually prefer 5, 15, 30-minute time frame, and I'm going to show you different examples in the end. But wait for the next candle to close, because then you can clearly see were those buyers, were those sellers, and is this zone going to be now a support or resistance? So let's say we are looking at 5-minute chart, okay, and we see a candle with unusually high volume, just here, and we open our footprint chart for this specific candle. And the footprint in this example will tell us that the large clusters of trades happened inside this very candle. So you can see the bulk of bullish trades occurred near 45.90 level, and the candle closed higher. So the next candle goes higher than the bunch of green stock of like deltas inside of this footprint. This gives you a clear message. Buyers added to their positions at this level. So some big buyers entered lots of positions, pushed the price higher, and now this area becomes an area of support. Next time when the price comes back to this zone, we might consider a long setup, expecting the price to react again from the same zone and expecting the big buyers who entered the market and caused this big volume to protect their long positions. And we can see how the price surged up for more than 100 ticks again from this very zone. So it might look like a small move to the upside because it's 5-minute chart, but this is 100 ticks moved to the upside. 100 ticks per, like this is more than 100 ticks actually, but 100 ticks per mini S&P 500, this is more than $1,250 per each contract. So the key takeaway from here is that high volume areas often mark the zones of high interest for big buyers or sellers, depending on the situation. And this is exactly the same chart. I'm gonna show you this example afterwards. And that is also the 5-minute candle. Yeah, that's also 5-minute just inside of the footprint. So the high volume areas mark zones of big interest of buyers or sellers. These zones become potential support or resistance zones. And with a bit of extra confirmation from footprint charts of the horizontal volume profile, which we're going to be talking on the 4th webinar of the series, we can narrow them down precisely and use them in our trading setups. Okay? So how volume shifts in the market from buyers to sellers is the next topic that we are going to be taking. So another important use of volume is identifying the shifts on control. Here we saw a confirmation of control of buyers. The market was already going up, and then someone big entered the market and the price pushed higher. Now we're going to take a look at the shift of the control. When market initiates the move from buyers to sellers and the other way around. So vertical volume combined with price behavior, or for example, footprint charts, as we are talking about today, can help us catch those moments early. And one of the most common signs is what is called the volume climax or the reversal bar. Let's walk through an example. We are going to have a look at the different entry zones and 2 different setups, both reversal and the trend continuation in the end, of our today's webinar, so make sure that you stick till the end. Okay, so let's have a look at this example. Imagine that the market has been going down for some time, as you can see here. So we had a steady downtrend and the volume was approximately same with a couple of moves to the upside and downside, an increase and the drops in volume. So it may be in the downtrend, as a trend unfolds, the volume can be steady or it can even be increasing, showing that the sellers are in control and taking more and more interest in the downtrend. But then at the bottom, as you can see on the example, you suddenly see an extremely high volume spike, and yet the price stops dropping. So picture this, the candle makes a new lower low, just like here. The volume on that candle is the largest that we've seen for a while, and yet the candle closes with a long wick to the downside. Then we look inside the footprint, and we will notice that the heaviest volume is located in the wick, not in the body of the candle. So this is a normal view with Japanese candlesticks and a high volume cluster, like high volume spike on the volume indicator. And this is a view from the footprint chart, where the cluster show the volume distribution in every single tick. So as you can see, the majority of the volume that is rounded and highlighted for you is located in the wick and the bottom of the candle. This is a classical signal of shifting control from sellers to buyers. Why? Well, because that massive volume at the bottom tells us that sellers will throw in everything they have at the market, tons of different sell orders, but price didn't go much lower. That means that there was an equal or even stronger, as in this example, buyer on the other side, absorbing the selling pressure. And as a result of this, the sellers lose momentum and the buyers take over. Here, in this example, vertical volume acts as a climax signal, a burst of activity right when the trend starts reversing. Often, if the volume is 2 times or more above the average, it's an early warning sign of potential reversal of the price. You could say it's like one team, for example, they say the bears made their final push to the downside, okay? And buyers, bulls, are stepping in and taking the ball. So in volume analysis, these bars are sometimes called the stopping volume as well, beside the volume climax. But no matter how you call it, okay, this is a sign, and again, we wait for the next candle, but this is a sign that something is happening and you need to pay attention. If you are already in the running trade, you might want to move your stop loss and profit, for example, or you might consider closing it if the next candle closes in the opposite direction to your current running position. Now, of course, again, volume alone, like in this view, isn't guaranteed reversal signal. It's just an early clue for you to take attention, to take your attention and turn it into this specific situation in the market. But again, you can use additional confirmations, like it can be patterns, it can be margin zones, it can be dynamic levels, it can be the TP1 market profile and the volume profile, which we will be talking about in the next webinar, or it can be footprint to strengthen the case. But again, the volume spikes anyway tell us something crucial. A new force is entering the market, and especially when we see an unusually high volume bar and price fails, like in this example, to make a progress in the trend direction, it often means the power dynamic is changing. So let's sum this part up to make it a little bit more simple, easy, and structured. Vertical volume, price plus price behavior, those are the key to spot shifts in the market control and market reversals. So if you've had a quiet volume like before in this example, and suddenly there is a spike at the top or at the bottom, those are the trade, this is a sign that trend is losing the ground, and reversal to the upside or to the downside, if it would be the opposite, is quite possible. So these moments are very easy to spot on the volume charts, and with the help of the footprint, you can filter out also false signals, and you can choose the real ones to actually make some profits on this. Now, combining volume and footprint charts also can help you, right, to confirm the strength of the trend and to enter the continuation trend kind of setups. But before we're going to talk about 2 examples of setups, let's sum it up how the combination of volume and footprint can help you in your trading. First, it can help you to spot that something important is happening. For example, if you see a volume spike, that's your signal. Hey, pay attention to this very moment. But the footprint tells you exactly what happened, not that just something is happening, but also what had happened. Are those buyers? Are those sellers? And where inside the candle exactly it happened? At which price level were those trades executed? Which price level can you now use as an entry point or the exit point for your trades? Secondly, the footprint helps you to validate or question the quality of that volume signal. So let's say that the volume is unusually high. You check the footprint, and inside the candle you see a heavy fight. Big buys, big sells, and delta is approximately around 0. That tells you that the force is balanced, bulls and bears are fighting, and in this case the signal is quite mixed. It may be a start of the reversal, or it can be possible a zone of consolidation. So in this case, if we see that delta is 0, but the volume is high, we may consider staying away from the market. Now, in other scenario, for the contrast, that if you see the high volume candle happening and you enter the footprint chart and you see one of the sides dominating, like for instance, for example, 80% of the volume comes from aggressive market buys and the delta is strongly positive, you have a clear picture now. It tells you that buyers clearly are winning this battle and the volume spike carries more weight. So when volume and footprint speak the same language, your confidence in the signal increases. And for instance, if the footprint tells you that the volume was empty and unquality, there is a fight and the forces between buyers and sellers are balanced, you may just stay away from the market and not enter such risky positions. So you can filter it out. And the last one, thirdly, combining volume and footprint gives you more precise trade entries. So here is how. Volume, again, highlights an important zone, like in the examples that we've seen before. Say a resistance area marked by a large volume bar at the top of the move. And you are thinking now about taking the short sell position. But the question is, when and where exactly should you be entering the trade? And that's where footprint comes into play. You can wait until the footprint shows a sign of the shift, for example, large red clusters, so aggressive sell orders, or a series of sell imbalances at the top of the zone. And when price starts pulling back from your level, you will have a trigger to enter the trade. So instead of blindly shorting just because the volume is high and the price is reversing, you wait for confirmation that sellers are actually taking control. And you can see that clearly in the footprint charts using the bid and ask delta color distribution, which I gave you the workspace for in the previous webinar. So then, and only then, when you can see the activity of one of the sides taken over, you take the trade. And you could summarize it like this, essentially. Everything that we are talking about today can be summarized this way. Volume tells you what and when is happening, and footprint shows you how, where, and who is making it happen. Together, all of this volume and footprint combined give you a 3D full picture of what is happening in the market. And I hope this makes sense, because now we're going to move towards from theory to practice, and I hope that you will be able to grasp it, understand it, and apply it in your own trading after today's webinar. So now we are going to break down 2 trading setups where this combination of volume and footprint gives you a real trading edge. Okay, I'm now going to be shifting to the real charts to break down a few scenarios together with you. But if you are following so far, if this was clear, can you please put some plus in the chat while I'm going to shift my screens? Can you please put some plus in the chat? So I know that you're following. And once again, I want to remind you that if you will have any questions, you can post them in the chat already, or you can wait for the Q&A in the end. In any case, I'm going to be able to answer all your questions, majority already in the end of our today's webinar, where we're going to have a Q&A session together. Okay, I see pluses here in the chat. Fantastic. Milena, Paul, Otas is here. Good to see you. Amazing. I see all of you. Fantastic. Thank you for the interaction together today. I really love when interaction is continuing, because then I can see that you are following and I may confidently move forward to the next topic. So in front of you, you can see the chart of footprint with volume distribution. We're going to be changing it now. And below is the normal volume indicator. To be able to add your volume indicator to the chart, you go into the indicators and you type in the volume. Now, apologies for this. You will be able to see the volume and volume on chart. The difference between those is that volume indicator has a different space, so the different part that it's using on the chart, so you can hide it and unhide it whenever you need it. Volume on chart is going to always be visible. I prefer the one with a separate panel because it helps me to clearly see the volume. And if I don't need it at this very moment, if I don't want to use it, if I don't want to see it, and I want to focus on different market signals, I can just hide it and it's not going to take space on my chart. You can add your volume indicator to the workspace that I shared with you in the previous webinars. So you can just go into the same workspace, upload it into your others platform, and then indicators go ahead and add your volume to it. Okay. So the first practical setup that we are going to be exploring today is a reversal scenario. This is when the market has been moving in the one direction, okay, either up or down for a while, and we are looking to catch the moment when the move exhausts and reverses. This is where volume and footprint can be incredibly helpful, so you can see several signs of the potential reversal and take a trade. Or you can also see the sign of the market starts moving against you if you were trading in the trend already, and save yourself some money and exit the market early before the move reverses all the way to your break even, which is extremely helpful. So there are several signs. I'm going to talk it through and then we're going to move on to the chart. There are several signs of the potential reversal using volume and footprint. The first sign is the volume climax we talked about earlier. So when at the end of the trend, a candle, or even it can be several candles, appear with abnormally high vertical volume. And this is going to be your first red flag, because it could mean that we are seeing a buying or selling climax. For example, at the bottom of the move, just here, you can see the highest volume in pretty much the whole day before that on a quite bullish candle, bearish candle, right? But with a long wick to the downside. This is an example that I took for my presentation today, so let's have a look at this together. If I'm going to zoom out, you will see that the move has been unfolding for a while to the downside. We could see that from this very moment on, the price continued to drop and the volume started increasing, which confirmed the strength of sellers. So all the way here, if you would be entering short, you could keep holding your short position. And at the bottom, what happens is we see the bearish candle, but with a long wick to the downside. And this candle carries 15,000 contracts, whereas the average was somewhere about 5,000 contracts. Okay, from a couple of thousands, from 1,000 to 5,000. This is 15. This is 3 times higher. And you can see that the price starts reversing afterwards. So the next candle is also with a long wick to the downside. And the next candle is a reversal. So this is a volume climax that we are talking about. Now, the second sign of the potential reversal using volume and footprint combination is the weak price follow through. This is a situation when, despite the huge volume, price stops moving in the trend direction. It's like hitting a ball, for example. Often that volume climax candle has a long wick, just like here, in the direction of the previous trend. So the previous trend is bearish, the wick is in the bearish direction, okay? And the next candle the next candle immediately reverses against the trend. Now, in this situation, not the next candle, but the candle afterwards reversed against the trend. Sometimes it doesn't have a wick. I prefer when it has the wick, and then the candle reverses. Okay, that tells us always that bulls, in this example, are taken over and bears are all spent out. They spent all their energy and they cannot push any further. And the last is the footprint confirmation. So once you see this, you see their wicks of the candle. You see the high volume, which is abnormally high, 3 times higher than the previous one. You can zoom in and you can see how the volume was distributed. Now, this is a volume type of footprint, and this is 15-minute chart. So we can see that the majority of the volume right here is distributed in the wick and the bottom of the body of the candle. You can see that the next candle also fails to go beyond this level. So this is your volume zone. The candle fails to go beyond this level, and the next candle starts reversing. Okay? So this is your common pattern that you want to see to enter the trend reversal situation. At the bottom of the move, a cluster with a high activity, okay, in this case, a high volume inside of the footprint, you highlight the zone with the footprint. The price stalls. So you can see that their buy limit orders are absorbing the sell by market activity. And footprint shows you that the big volume is traded at the very bottom of the candle body and inside of the wick. Next candle confirms that price cannot push any lower than this. And it means that there is a buy limit wall of orders. And sellers are hitting it hard, and they are failing to break through it. The result is in front of you. So those sellers are now trapped. Their aggression cannot do anything anymore to the price. They are failing to push the price through, and they start exiting the market. Okay? That's a strong sign that the move is done. So the shift in control is happening here in those two candles. Now, what happens next is you will see that delta will be showing the buyer dominance. Now let's go and shift to the bid and ask delta colored. Here we will see, and I'm gonna make it a little bit brighter so you can clearly see their candles. So I'll do it like this, and I'm gonna close the footprint, the volume chart, because I want you to see that what is happening. So we see that the candle with a lot of volume has mixed signals. You see that the footprint is mixed. It has both green and red deltas inside of it, one after another. Now, this is very important sign for you that this is too early to enter the market. Again, you can enter the market, but this is going to be a high risk trade. What you want to see is the shift in the activity to the buyer side. So your volume, majority of the volume is here. Again, if I'm going to shift to the volume, you can see that here is the majority of the volume. If we shift to the bid and ask delta colored, now we are waiting until buyers take control and we can start seeing highly green positive deltas appearing inside of each candle. We see that sellers are still trying to push through but failing. The price still goes up. So sell by market activity continues, but buy limit orders are absorbing this selling activity. And the candle again closes above this huge volume zone with a long wick to the downside. And the next candle already shows us the green footprint. So we see that majority of the candle contains green cluster inside of it. So this is a sign that buyer starts taking over. Now, what you want to do is either you want to enter buy by market after this candle, which already happened, but I always prefer to wait until the price gives me a little pullback. Even if it's 10 ticks, of course, better if it's more, but even if it's a 10 ticks, I always wait until the price goes back to either my major delta like levels, price levels, which we talked about on the second webinar, or to my zone of volume that was traded before. We see that the price pulls back exactly to this volume zone. And what is quite interesting is, as you can see, again, those three candles contain different bright green deltas inside of it, which are showing us that the aggressive buyers are entering the market actively, and the asks are increasing. So this is what you want to see. The price starts going up. The next candle, you see the positive delta overall, the large green clusters, the price fails to go down and it is going to go up. Once again, this is telling us that buyers are taking control over, and that in the matter of fact, vertical volume was the reason that we had a look at this in the first place, because the vertical volume showed us the abnormal activity overall, if we look at the previous whole trading day before this. Okay, so let's find another example, and in the meantime, let me know if you have any questions. Okay, there is a question. Wait for more green in a candle. Exactly. So what you want to do is you want to confirm that the powers has shifted, because once again, the volume itself is not enough. We have several confirmations here. We have high volume candle at the end of the move with a long wick in the direction of the previous trend. We look at the volume footprint and we see that the majority of the volume was traded in the end of the candle, so at the bottom in the wick of the candle, and the next candle fails to go below it. But if you look at bid and ask distribution, you can see the mixed signals. You can see red and green together, which means there is a fight between buyers and sellers. You want to enter the market with a high probability setup. So you are waiting until buyers take over before making your decision. Next candle, you see bright red clusters, which if you watch the previous webinar is going to tell you that those are buy limit orders absorbing the sell by market orders, because you see lots of orders executed on bid, but the price fails to go down, and you wait for more green. You want to see it green, green, green. Aggressive entries here. When the price spikes to the upside, you see the first green footprint. The conservative entry is wait for the price to pull back to the previous volume zone, which was inside of this huge volume, vertical volume candle. This is why we use the vertical volume candle combination with footprint. You wait here, you wait until the footprint essentially shows you green deltas again, and then you enter the market. You see the positive delta You see green bright deltas clusters inside of the candles, which show you the aggressive buyer activity, buyers taking over. You can place your stop loss just below the high volume climax. So you can place your stop loss essentially below this zone, okay, right here. And your take profit can be near the next meaningful support level or resistance level in this example, or as far as your new uptrend allows. You can use the same signal to exit the trend if it happens, right? You can see the reverse signal and exit this trend. So just one tip for you, don't try to catch every single reversal, every single move to the downside or to the upside, and wait for footprint, because just an vertical volume high activity doesn't tell you that the price is going to reverse. It can also be used for the trend continuation setup. So volume brings your attention to this situation. However, footprint tells you, are you expecting reversal or are you expecting the continuation of the same trend? No, I do not use the order blocks. Now, if you have any questions, please let me know in the chat. I saw the request to have a look at 6E futures. I'm going to try to do it in the end because we still have one more setup to go through. And if you have time in the end, I'm definitely going to be more than happy to help you with breaking down Euro futures as well. But let's have a look at some other examples. Now I'm going to shift to the higher time frame to show you, well, one time frame higher, basically 30-minute time frame, to show you another example of the trend reversal. And then I'm going to show you the trend continuation setup. Now, for example, I'm going to show you the trend that I would most likely not take. Yeah, I would most likely not take this trade because you look at this. You can see the spike in the candle. But why wouldn't I take this trade? Because if you see at the candle itself, you can see the equally distributed volume. So you see some volume on top, some volume at the bottom. So although you have a spike in the volume, vertical volume, which is showing 16,000 contracts, they are distributed evenly across the whole candle. So this is some of the things I wouldn't be taking a trade with. Okay, why? Because you can see the equal distribution of it. Oli is saying yes, I do trade S&P 500. Actually, in fact, we might have a look at this right now together. Futures on currencies are slightly, like, I don't really like them because they're too liquid for this kind of analysis. It's really good sometimes, but it's not something that I prefer using in, in the scenarios. Let's have a look at this situation. Let me delete all of my markups. Let's have a look at this situation. What we see here is the downtrend has been unfolding for quite a while. In the end, the volume starts increasing. We see the New York opening. The volume increases. The price continues to fall. What can we see suddenly is the price jumps up. You see the clear, strong bullish candle without almost any wick to the upside. Very strong candle. You can also call it an engulfing candle, so it fully covers the previous body of the bearish candle. And this contains almost 200,000 contracts, where, as a matter of fact, the previous 2 days we didn't have such an activity. So this is definitely something you want to keep an eye on. Now we go closer and we open the footprint chart. What can we see is that we had quite a bullish footprint, but there was quite an activity of sellers, right? The bid activity, there was a disbalance on the bid side. You have a clear, bright red deltas. So what I want to see is, I want to see how the price is going to react on it. I want to see either the price is going to close above or below this zone, because I want to know if this is a sign that sellers stepped in and now the price is going to continue lower. In this case, I'm going to be looking for short scenarios, or I will wait for the price to close above it, and I will know that buyers were able to still push through, succeed, sellers failed to send the price lower, and I'm going to be looking for a buy. So let's have a look at this. I'm going to look at the normal candlesticks, and we see that the next candle closes higher, which means that this zone where there was a fight between buyers and sellers actually appeared to be below it, and buyers succeeded because buyers were able to push the price higher. So again, one of the main rules, wait for the next candle to get the precise entries. In this case, we see that the price closed higher, it pulls back, and you can look for taking orders already in this very next candle. If you want to be more sure, you can wait until the price starts showing you the bullish footprint. So this already cluster contains the more green, or essentially only green bright deltas, and this candle itself is already a sign that you may look for the bullish continuation and for the long market entries. Let me see the charts. Is there a way to notify when there is a volume spikes? If you go to the settings of your volume tool on Atas, you can go down and you can essentially actually enable alerts. So you can enable reverse alert when the volume reverses. And it's going to help you to be notified when something happens. Also, what you can use is the filter. So you can set up the filter when, for example, which is going to notify you, for example, if you have more than 20,000 contracts traded, when the volume starts increasing, or 30,000 volume traded. Well, it depends on the asset that you trade. But you can use filter, which also going to highlight a very specific amount of contracts traded at this very candle, and is going to tell you, hey, pay attention, something is happening. Okay, so let's have a look at other scenarios. Again, if you have any questions, please let me know in the chat. I'm going to actually open my normal one. One moment. Apologies for the technical interruption for 10 seconds. There we go. So let's have a look at other scenarios. Let's have a look at the trend continuation setup. Now, if you got the reversal setup, can you please put plus in the chat if you understand the reversal setup? So essentially, you wait for the high volume spike. You wait for the next candle to show you where the candle goes. And if it goes against the trend, you go in the footprint, you identify where was the volume traded, and you wait for the price to start moving in the opposite direction to the trend, pull back to the previous volume zone, wait for the footprint to show you the direction that you want, and then enter the trade. Okay, I see some pluses. Fantastic. Thank you so much for your feedback in the chat. Martin, I cannot shift the entire setup because it's going to take too much time, but the principle, if you're using it on the black background, is exactly the same. Okay, fantastic. So let's continue with the trend continuation setup. Now, this is actually the valid example. However, we did have a gap, but I want to show you that even in the current market volatility, with the current situations, they're still the same situation, the same setups, actually valid and working fine. Now, what you want to have a look at is when trading with a trend, you want to find the entries which are going to allow you to ride the continuation of a strong move. So this is an opposite of the reversal play, right? Here you want to join the momentum instead of waiting for the shift in the momentum. So you are looking again for the combination of increase in volume or the spike of volume and confirmation of the footprint chart that the move is real and it's not just a fake spike. Okay, so because if it's a fake spike, you're going to have the volume, but you're going to barely have any bright deltas because the amount of asks and bids is going to be approximately the same. Now, let's have a look at this. The price goes down, right? And it breaks below the previous support here. So we had a support right here. The price breaks to the downside and starts slightly to consolidate, right? It goes up and it starts moving down. You want to see if there is still the fuel for the market to continue to go to the downside. And you can find the answer if you look at the footprint clusters and delta inside. So you zoom in. This is a 30-minute candle inside of mini S&P 500 footprint. Now, I know the numbers can be confusing, so you don't even need to look at the numbers. You want to look at the brightness of each cluster. So you have a look at the high volume spike, which is contains 120,000 contracts before the market closure, and quite a big amount of actually selling pressure. Buyers were trying to push the price higher, but the candle closed bearish, and in the end, we see the selling activity picking up. Now, what you want is to wait until the market opening in this case, because this was the candle before the market closure. So you want to wait until the market opening and wait where the move is going to start picking up, to the downside or to the upside. As you can see here, the market opened with a gap to the downside. This candle puts potentially now your resistance because it had a high amount of volume and it had a high selling pressure. So what you can see here is that the price returns to the same area and starts going down. Now, what I want to show you also, and we're going to talk about more about it on the next our webinar, but you can use the market profile and TPO tool in your ADAS to place it over this very candle. And if you go into the settings of this tool, you can choose the profile type into delta, and then it's going to show you where was the biggest disbalance between buyers and sellers in this very candle. So you can see how the price comes almost to the same zone. Now, I told you in the previous session that I actually take always sells and buys 3 to 5 ticks below or above its 5-minute time frame. You can take obviously more if it's a higher time frame. So you can see how the price goes exactly to the same zone, and you can start taking the sell order. Even if you miss this trade, you can enter on the next bearish footprint, which appears to be right here, right? You can layer without the numbers right here. So the continuation setup is pretty much the same thing. You can recognize and confirm it by rise in volume or a spike of volume, okay, when the trend unfolds. So say the market breaks below the previous support right here, right? And you see the increase in the volume confirming that there is still strength in the market to continue pushing further, and a clear footprint in the direction of the trend. And you wait for the next candles to show you the next direction before taking a trade. So how to enter trade continuation setups is you wait for the pullback after the breakout. You see the candle with a high volume and with a bright footprint. You wait for the breakout until the price shows you the direction. In this case, the price opened down after the market gap, shows you that most likely this is going to be the area of resistance now. And as you can see, that's exactly what is happening. The price breaks below the support on the market opening, pulls back towards the zone where we saw bright red clusters before the market closure. Volume during the pullback, as you can see, is low. Okay, look at this. The volume is low and it starts increasing on the pullback candle. So sellers start entering the market here, and you can place either the limit order or wait for the negative footprint and then enter the market. Let's have a look at one more example, and then we are going to I'm going to have a look at the question that you may have left. This is the same example, actually. To find something else for you. This is a reversal example we talked about before. Here, the trend continuation setup without the gap. I was looking for something without the gap because market has been gapping quite a lot due to the volatility. What can we see? The principle is exactly the same, step by step. Price goes down, and just on the normal candlesticks, you see how with the trend picking up the momentum, the volume also starts increasing. Volume increases, and then you see the spike of volume in one of the candles right here. The spike of volume is higher than anything you have seen for the past 2 trading days. This is 262,000 contracts in one 30-minute candle. And if you look inside the footprint, you can see quite a bearish scenario. You can see a lot of sell orders, a big disbalance on the bid side in the end of the candle, and the next candle closes below it. So once again, you wait for the high spike in volume, you zoom in, you find area of high volume, which is the whole this candle, or you see the disbalance on the bid on ask. In this case, it's bid, which is confirming the strengths of sellers. And you wait for the next candle to show you if this is the confirmation of the new resistance. In this case, the candle closes lower, and this zone, the whole red zone where sellers were stepping in and adding to their positions, is now your resistance zone. You can already enter the market here, or you can enter the market on the second pullback. You had multiple moments where you enter the market here, and you can place your stop loss above this candle. So above the candle with a very high volume, you place your stop loss here, and you see how the price continues to drop down for quite a while. Let me close this. For quite a while, right? You can see the price continues to drop. So this was a beautiful example of the trend continuation setup using volume and footprint confirmation at once. Yes, you can use footprint on the second charts as well. I am not using it. I prefer to use it on 5-minute time frame because seconds is a little too fast for me since I'm not a scalper, but you definitely can use a combination of volume and footprint charts also on the second charts. You can also use it on the different types of charts, right? Because the principle of the price formation market auction remains exactly the same no matter the time frame you look. It can be seconds, it can be hours, it can be days. So if you are a scalper, intraday trader, or position trader, you are going to be able to use the same exact principles everywhere. Do you use vertical volume on range charts? Paul, do you mean the range charts as a type of the chart range? Or do you mean when the price is ranging and is consolidating? Do you mean the type of the chart as a range? The range? Yes. Okay. So I don't. The reason behind it is that the Japanese candlesticks are based on time, right? They are based on time, and this is why the volume is valuable here, because it shows you during this specific period of time what was happening. Was there an interest or was there no interest in the market from the market participants? If you are trading range-based charts, range XV, range X charts, it doesn't hold value there. Now you can still use the footprint, or for example, you can use the volume-based footprint when you trade range X, range XV charts, but not the volume indicator itself, because it's not going, it's very unlikely to help you in this type of trading. How you can figure the trend is going on or it's reversing just by waiting. Again, you wait until the price, you wait for the big candle, like in this, for example, scenario, Look, this is a beautiful scenario. I had this example on the presentation as well. We had a stable trading. We had a stable volume. Now you have a spike of volume. What you want is you want to see how the market is going to unfold afterwards. So you wait until the next candle, and you see the next candle closes below, and the previous one with a big volume closed with a very big wick to the upside. You can see that inside of this week, you had the majority of the volume traded. And not only the volume, but you also have the very bright negative delta traded right here. So you see that sellers stepped in, took over, and price pushed down. The next time price comes back to the same zone, it can be used as a resistance zone for your trade with a stop loss either above the candle, or if you want to shorten it, at least above the majority of the volume, which is above this zone right here. Right? So you place your stop loss here, and you can enter sell limit order or wait for the footprint confirmation. And as you can see, when the price comes back, it may look like not a big move, but again, it's 30-minute time frame, and it's more than 50 ticks from the bottom of the zone, and more than 64 ticks in total. Okay, it's 1 to 2 restore word, a beautiful trade can happen as well. And then, of course, you see the price continued consolidating. So you always wait for the next candle to close. You wait for where the volume was distributed in a week, so or inside of the body of the candle in the middle, and you trade from this volume or from this bright footprint. So today's webinar is essentially the combination of the second webinar, where we talked about the strategies based on the footprint charts and delta color, and the volume indicator. Okay, I don't see any more questions. Do you usually aim for 1 to 2 restore words? Now that's a difficult question, because my restore word is not determined at the moment when I enter the trade. Now I add up to my positions, and I add to my positions based on the strategies that were discussed in the second webinar. So I might enter the trade where it's 1 to 2 restore words, and I'm going to end up with 1 to 5 or 1 to 6 restore words in the end, because I'm going to be adding up on this kind of situations. I'm going to be adding up on the bright deltas, on the high volume inside of my trend. So I aim at least 1 to 2 to enter the position, but I add up to winning positions, and it allows me to increase my risk to reward outcome. Now for this, actually, I discussed on the second webinar, Shabir. So please go back and rewatch the second webinar, because this was a whole topic where we discussed how to determine if the buyers are entering the position, exiting the positions, how we can see the absorptions of buyers or sellers, for example, by the limit orders. And if I would cover it now, it would take us another half an hour. I don't want to hold you here for another half an hour, but it was all discussed in the second webinar. So it would be really great if you would go back and actually rewatch it, because I believe it's going to give you lots of value. Okay, so I don't see any more questions. Is there a webinar on the cumulative volume delta? Not yet, but I might include it in this series. So the next webinar is actually going to be on the volume profile and TPO charts, which is going to be the extra layer to what we already talked about. So in this whole series of 7 webinars, we are actually slowly but surely, step by step, building the trading system for you, which you can use for different types of market, different periods. No matter if you're a scalper, intraday, or swing trader, you can apply the same principles and combine all of this setups that we are talking about in one trading system to make powerful trading decisions. If you loved, enjoyed, and got at least a little bit of value on today's webinar, can you please put plus in the chat? I would really love to see your feedback. So on today's our webinar, we covered two of my absolutely favorite trading setups when it comes to combining the footprint chart and the volume indicator. And I cannot stress it enough. The most important is for you to wait where the next candle closes, because this is something that is showing you whether it was an activity of sellers, buyers, and it can give you the very powerful entries if you are just patient enough. Okay, so with that, I will be wrapping up our today's webinar. It's a huge thank you to every single one of you who is joining and for being so active in the chat today. I really appreciate your all comments. I see lots of pluses in the chat. Thank you so much for such great feedback as well. And on our next webinar, we will be covering how to use the volume profile and TPO charts. Now, I absolutely cannot imagine any of my analysis, any of my trading days without volume profile and TPO market profile. So make sure that you attend the next webinar. It's going to be just in 7 days from now, the same time, the same place. For those of you who are registered, and that's all of you who are here, the link to rewatch the current webinar as well as to watch the next one will come to your email. So make sure that you are there. Now, I hope that today helped you a lot to look at the volume in a new way and gave you more clarity when it comes to spotting high quality trading opportunities. And again, if you found this helpful and you're ready to try these tools in your own trading, now this is a perfect time to act. Head over to ARA's website, register your account, download the platform, and you will be able to activate your free trial. Your free trial will give you the full 14 days to explore all features. And during your trial, try building out some footprint charts, or just head back to the second webinar down space that I shared with you and apply the volume indicator to the same workspace. It's going to give you an exactly same setup as we've talked about today and you saw on my own charts. So look for some of those setups that we discussed today, and I can't wait to hear back your feedback on the next webinar about the setups that we've discussed on our previous sessions. So again, I can honestly say that this method changed the way I trade, and I really hope that they do the same for you, because I do know that they might change everything when it comes to your trading and bring you the breakthroughs that you're waiting for. And again, don't forget that if you're going to be back next week for the next webinar in the series, thank you again for your time, your attention, and your great energy today in the chat. I appreciate every single one of you. I wish you, again, all the success in your trading and deeper insights in the market. And I'll see you in our next lesson.